Welcome to Medmarc's webinar series. Today's presentation is titled Grants or Startup Tax Credit, Which One is Right for You? I'm Kate Klaus, staff attorney in Medmarc's Risk Management Department. On behalf of Medmarc and today's presenters, Jacob Setterboe and Jim Foster, thank you for joining us. Dr. Jacob Setterboe is Director of Grants at HIREtech, where he helps life sciences companies obtain non-dilutive funding. Jacob focuses on small business grants from the National Institutes of Health. He has provided consultation and technical writing for various therapeutic areas across the spectrum of NIH's interests, including pharmaceuticals, medical devices, digital health, and healthcare delivery. Jacob assists with experimental design and commercialization components of each project. Jacob regularly vets early-stage companies with respect to innovation and commercial potential to determine their applicability for grants. Jacob also assists with startup R&D tax credits at HIREtech. Jacob is a founding member for the Venture Mentoring Service at Houston and an advisor for the Texas Medical Center Accelerator. Jacob also served as a reviewer for the Texas Emerging Technology Fund, a due diligence team member for the Houston Angel Network, and an advisory board member for the Terry Foundation. Jacob received his PhD in biomedical engineering from the University of California, Davis, and his BS in civil engineering from the University of Texas at Austin. Jim Foster is the National Tax Director at HIREtech, headquartered in Houston, Texas. Jim currently specializes in the R&D tax credit, the IC DISC export incentive, and the Section 199 domestic production activities deduction. Jim has been practicing in the general area of taxation and tax law for over a decade. In that time, he has become one of the leading producers of successful R&D tax credit cases for his corporate clients. Further, he has a proven record of successful tax cases that range from IRS audits and appeals to various state-level tax audits and appeals. Prior to HIREtech and after obtaining his JD, Jim worked for a national tax consulting firm where he specialized in the R&D tax credit and the IC DISC export incentive. While in law school, Jim worked at a public accounting office where he helped the firm advance in and maintain double-digit growth. Jim received his BS in political science from Texas A&M University and his JD from South Texas College of Law. He is a licensed attorney in the state of Texas. And with that, I am pleased to turn things over to Jacob.
Thank you, Kate, for the introduction, and thanks for having us today. Just to give an overview of what we will discuss today, I will start with a discussion of grants, and then I will give a high-level comparison of grants versus the R&D tax credit. Then Jim will take over and give more details on the R&D tax credit and specifically details on the payroll or the startup R&D tax credit. And at the end, we'll have time for questions and answers. Throughout this presentation, we will be referring to this taxable income versus time plot. So taxable income is on the y-axis and time is on the x-axis. So on the left hand of the plot, that's net operating losses, which if you're a startup company in the life sciences, you're painfully aware that you're stuck on that side of the plot for oftentimes several years. But hopefully you make it to the right side of the plot where you get taxable income and start making a profit and therefore start paying taxes. For grants, it does not matter where you are along this plot. You can benefit from grants at any stage. There are four main reasons why grants are an attractive source of funding. Number one is it's not a loan and you never have to repay the funds. Number two, it's non-dilutive and you never have to give up equity or draft up one of the cap tables shown on the slide here. Number three, you don't have to give up intellectual property or your IP to receive a grant. And finally, number four, it provides valuable recognition, verification, and visibility for your company where if you get a grant and you post it on your website, that shows to others that not only did experts in your field review your project and deem it innovative and worthy, but also the federal government looked at your company and said, yes, they are deserving of federal funds. And so that can help you with other sources of funding such as venture funding or angel investments. So which grants should you go after? There are literally tens to hundreds, depending on your topic, and it's very important to choose your battles wisely because there's a lot of grants that you do not want to go after because you do not want to compete against MD Anderson and Harvard and University of California professors or these research institutions where it's their job to write grants, win grants, write journal articles, and then repeat the process. So essentially, you don't want to have to compete against stacks of journal articles and huge resumes as an entrepreneur. So fortunately for small businesses, there's the Small Business Innovation Research, or SBIR, and Small Business Technology Transfer, or STTR program. And what this is, it's a grant program that only funds small businesses, and it essentially eliminates that competition from those professors in those universities that I mentioned on the previous slide. So not only that, but it specifically funds research and development, or R&D, that has the potential for commercialization. So there are many other grants out there that they basically fund basic research or basic science, but these grants, they want you to commercialize and they want you to develop products. How this program works is if a federal agency spends a certain amount of funding on R&D, they are required by law to have an SBIR and sometimes an STTR program. Today, during this presentation, I will focus on National Institutes of Health, or NIH, because that one is most applicable to the life sciences field. In terms of eligibility for these SBIRs and STTRs, you must be for-profit, located in the U.S., and have less than 500 employees. And for your ownership, you must be more than 50% owned by U.S. individuals. Note that NIH does allow for SBIRs. They allow companies to be more than 50% owned by multiple VC firms. In terms of eligibility for your facilities and team, for the SBIR program, at least 67% of the funding and the research must go through your small business and your facilities. Also, your principal investigator or your PI must be employed 50%, at least 50%, at your company. So the STTR is basically the same program as the SBIR, except it's a mandated partnership with your company and a single research institution or university of your choosing. And in this case, at least 30% of the budget must go through that partnering university or institution. And then the percentage that goes through your small business is reduced to a minimum of 40%. One important note is NIH allows the PI for STTRs to be employed at the university. So essentially, if you're a startup with a smaller team, maybe smaller facilities, an STTR is a great way to get a great PI without having to hire them away from the university and utilize those university facilities while performing your grant. In terms of the review process and the success rates for these SBIRs, even though it's a small business grant, the fact of the matter is most reviewers will be professors who, again, are experts in the field. They do try to mix in some small business expertise within the review groups, but it's mostly professors at the end of the day. So basically, this review group will review many applications, and the top 15 to 20% will get funded. How they determine who gets funded is these reviewers score it based on 5 criteria. First is significance, and that is how important your product is to the field and what type of public health impact it will have. Number 2 is investigators. Does your team have PhDs or MDs? Does your team have patents or commercialization experience that suggests that if the grant is successful, it will eventually be commercialized? Number 3, innovation. Is your product new to the world, and can you differentiate it from what other products are on the market or are under development? Number 4, approach. did you propose a logical, rational, backed by science approach? Number 5 is environment. Can your company and your collaborators' facilities execute the grant as proposed? So before applying, you want to look at these criteria and ask, is your project and your team among the best? Or do you have a chance to be in that top 15, 20 to 20%? So the award information, these SBIRs, STTRs are split up into 2 main phases. Phase 1 is a feasibility study. It's usually a year and up to $225,000. If you're successful there, you can apply for a Phase 2, which is up to $1.5 million typically and up to 2 years. NIH does have a fast-track option where you can apply for Phase 1 and Phase 2 at the same time, but unless you are experienced at grants, we do recommend against that because essentially it's doubling the amount of content for the reviewers to find one thing they don't like and then drag down your entire application. On to timeline to funding, and this is an example if you were applying for an April 5th deadline for NIH. And note that the deadlines are September, January, and April for their standard SBIR, STTR solicitations. So the little person there is looking forward at April 5th because this application is proposing a project you will complete in the future. And so you definitely want at least 2 months to prepare it. It takes a lot of time. And then once you apply and submit in April, it takes 3 to 4 months for the professors and the rest of the review group to review your application and score it. And then if it's scored well enough, it goes to the advisory council round. NIH then decides whether or not they want to fund it, determines what the pay line is or what scores will get funded. And then finally, if you are fortunate enough to get funded on the first time, it's typically 6 to 8 months from when you first applied to when you first see that money to start your project. So it's often the case where you do not get it on the first time and they allow you to resubmit it and basically respond to the critiques from the first submission. So in this case, you would apply in April. It takes 3 to 4 months to review, and you get the score back during that time. And so you should have enough time in this case to revise your application and resubmit for the September deadline. The process repeats again, and then from the first time you submitted the first application to the time you get the award for the resubmission, it can be as long as 12 to 14 months. So that was a high-level overview on grants, and now I'm going to give a point-by-point comparison to the R&D tax credit. So I mentioned for grants, it doesn't matter where you are along the curve, the taxable income curve, you can apply for grants. Previously, as in up to tax year 2015, for the R&D tax credits, you had to be on the far right side of that graph where you had enough taxable income to need to offset your taxes, to use the credit to offset your taxes, basically. But a major takeaway from this presentation, and Jim will get into it further in a minute, but for the startup or the payroll R&D tax credit, you no longer need taxable income. You can use it to offset payroll taxes instead of corporate income taxes. The top 3 reasons to apply for the R&D tax credit is very, very similar to grants. It's not a loan, it's non-dilutive, and you don't lose your IP. The big difference is you don't get recognition and people don't pat you on the back as much for getting the R&D tax credit. And the reason is the eligibility and the success rates are completely different. For the R&D tax credit, your eligibility is determined by your gross receipts or your sales and revenues and your qualifying research expenditures or your QREs, which again, Jim will describe that in more detail later. But unlike SBIR and STTR projects, you can have an R&D project that can be from any technology sector, from manufacturing to life sciences to dental repair devices, and also your project can be the most boring incremental project known to man. It doesn't have to be new to the world. You don't have to impress professors, and you only have to impress IRS agents, and they're impressed if you follow directions, which is sometimes hard to do. But if you follow IRS rules, and that's a big if, and that's one of the reasons why HIREtech exists, if you follow IRS rules, your success rate on these applications or these forms, these tax credit forms, will be near 100%. In terms of timeline to funding, here I am showing a March 15th deadline for the standard R&D tax credit. So these are companies with taxable income. So the person there at the bottom is looking backwards at R&D that was performed in the previous tax year, so tax year 2017. When that company files in March 2018, the tax credit provides immediate savings because it offsets corporate income tax. In the second example, this is for the payroll or startup R&D tax credit where the company does not have any taxable income. So same scenario where you look backwards at R&D projects worked on in the previous tax year, you file, but because this company does not have income taxes to offset, the government now allows small businesses to offset payroll taxes starting the quarter after they file their tax return. So again, high-level overview, one-to-one comparison. Grant success rate is 15 to 20%, and it's judged by professors. The R&D tax credit is near 100%, and it's judged by IRS rules. Grants are forward-looking at projects you will complete in the future. R&D tax credit is backward-looking at R&D projects you have worked on in a previous tax year. In terms of getting the money or the credit for grants, it can take 6 to 10 months from the time you apply. For the R&D tax credit, it can be instantaneous or it can be up to 3 months after you file. Finally, the amounts grants can be up to $1.5 million, typically for a Phase 2 SBIR, STTR. And the R&D tax credit for startups at least can be 8 to 12% of qualifying R&D. So final note before handing this over to Jim, if you qualify for both and you're a good match for both, you should do both because, again, they're non-dilutive. You don't have to pay it back. They're great sources of non-dilutive funding if they match your company.
All right. Thank you, Jacob. So what I'm going to do is I'm going to give an overview of the R&D credit, and then I'm going to spend a little bit more time on the startup R&D tax credit or the payroll R&D tax credit, as that will apply to more of the people on this presentation. All right, so the R&D credit has actually been around for quite some time and was designed to keep innovation and creativity in the United States by creating United States jobs. So in order to qualify for the credit, one of the requirements is that the work has to be done in the United States. So if you have a company that's doing work in China, we can't look at that. If you have an employee that takes 2 weeks up in Canada to work on an R&D project, we can't look at that. But as long as it's being done here in the United States, then we can absolutely look at it. Okay, so I said that the R&D credit's been around for a while, and actually it's been around since 1981 and was adopted with the Economic Recovery Tax Act of 1981. Between 1981 and the end of 2015, there were several expirations of the credit. I want to say it was 16 or 17 expirations. And what would happen is it would expire, and then there would technically be no credit, and then Congress would pass a bill that retroactively covered the year that just passed and covered the year coming, so it would be a 2-year extension. And this created issues for planning and reliability, and we'll cover that in a little bit. One of the other things that happened is somewhere along the line, the IRS implemented what was called the discovery rule, which said that whatever you were claiming the credit for had to be new or improved to the industry at large. And as you can imagine, the only people that were really able to prove that were the Fortune 500 companies. And Congress came back to the IRS and said, this is not what we intended this credit to be for. You're stifling the economic growth that we want here in the States. Get rid of this discovery rule and open it up. So that occurred in 2001, which allowed small to mid-sized companies to take the R&D credit for work that is new or improved to the taxpayer rather than new or improved to the industry at large. And then at the end of 2015, we have the Protecting Americans from Tax Hikes Act of 15, otherwise known as the PATH Act. And there were three historic changes that occurred then. First, the R&D credit was made permanent. Second, small businesses can claim the credit against the alternative minimum tax, or AMT. And third, startups can now claim the credit up to $250,000 against the company's payroll tax. So let's cover these just briefly here. So the R&D credit is now permanent. One of the biggest advantages to this is that companies can now do proper forecasting for their tax bills and include this credit as part of their budget. Additionally, when the credit used to expire, it always expired as of December 31st of a given year. For fiscal year taxpayers who had part of their year before the expiration and part of the year after the expiration, technically they were only entitled to the credit for the portion that was before the expiration. And this caused large headaches for a lot of these taxpayers. Now we don't have to worry about that. Okay, I'm going to give you guys AMT 101 now. And essentially what you're doing when you're calculating your tax liability is you calculate your regular tax liability, your RTL. This is how much tax you owe based upon the normal income calculation on your tax return. At the same time that you're doing this, there is a parallel income calculation wherein you determine your tentative minimum tax, shown here with the dotted yellow line. The tentative minimum tax is the amount of tax that you owe regardless of how much RTL you owe or you calculated. So if your RTL is higher than your tentative minimum tax, you pay your regular tax liability. If your regular tax liability is below that tentative minimum tax amount, you have to pay up to that tentative minimum tax, and that difference is called the alternative minimum tax. Now, one thing to make note is prior to the PATH Act, you had to have tax liability above this tentative minimum tax line in order to utilize the R&D credit. So if a taxpayer was in AMT, as we say in the industry, then they were not able to take advantage of the R&D credit. They could claim it, but they couldn't use it because you can't take your taxes below that tentative minimum tax line. All right, so with the PATH Act, starting with tax year 2016, for purposes of R&D credit utilization, you get to set the tentative minimum tax to 0. Now, you still have to calculate it for other purposes of tax calculation, but for using the R&D credit, we pretend that the tentative minimum tax is 0. And this means that if you have any regular tax liability, you're going to be able to use the R&D tax credit. Now, there is a caveat. This only applies if your average annual gross receipts are less than $50 million, which for startups is not going to be a problem. For most taxpayers, this isn't going to be a problem. This covers your small to mid-sized businesses. And when you get above that $50 million mark, a lot of times you have enough tax liability that you need help with the credit anyways. Okay, so let's go over that taxable income versus time graph again in relation to the R&D credit. So underneath the old rules up through tax year 2015, you had to have regular tax liability above that tentative minimum tax line, and then you were able to use the credit. With the new rules for the small business exemption, if you have any tax liability, even if it's below that tentative minimum tax line, you get to go ahead and use the R&D credit. Now, the area that's going to apply to most of you guys is the startup credit, which allows you to use the R&D credit even if you are in a net operating loss scenario. So the R&D credit since 1981 through the 2015 tax year was only able to be used against taxable income, meaning your income tax liability on your tax return. With the PATH Act, we can now use the R&D credit to offset your payroll taxes. However, there are some hoops that you have to jump through. First, your current year, which right now would be 2017, gross receipts must be less than $5 million. Second, there is a 5-year grace period ending with the current year, but you can't have gross receipts prior to that grace period. And we're going to be going over some examples later to go ahead and demonstrate this and how it works. But what ends up happening is you get to offset your payroll taxes on a quarterly basis after filing the return. Please note that the amount of credit that you can take against your payroll taxes or generate towards this is capped at $250,000 per year per company. Now, when you get the slides later, you can zoom in on this. This is the Form 6765. Even if you are planning on using the R&D credit against your payroll taxes, you have to include the 6765 on your federal income tax return. And this is the R&D form. It's got two different calculation methodologies, the regular credit and the alternative simplified credit, and that's just how you calculate the credit. Then Section C is figuring out how much credit you have for the current year. And then Section D, where we have the arrow pointed here, there's a box that you need to check, and then you specify how much of the credit generated above you're electing towards that payroll credit. And you can make an election up to $250,000 here. After you've filed your 6765 on the federal income tax return, then you get to start using the R&D credit against your payroll taxes, which are filed on Form 941, and you do this by filing a Form 8974 along with the 941. And what the 8974 does is it calculates how much of that R&D credit you've generated on the 6765 that you get to use on that particular quarter's payroll taxes. And whatever is left over will roll over to the next quarter. Okay, so let's take a look at what the rules are for the R&D credit. The traditional definition of R&D, where you're doing chemical experiments and hard engineering and things like that, is just that. It's a traditional definition of R&D. A lot of you may be doing that, in which case we're in good shape. The tax definition is actually much broader, though, and there's a 4-part test to determine what qualifies for the R&D credit. In order to qualify a project for the R&D credit, you have to have a new or improved business component developed for a permitted purpose. And business components are 6 things: products, processes, software, techniques, formulas, or inventions. This basically boils down to new or improved products or processes. So if you're developing a product or if you're developing a manufacturing process to make a product or anything like that, we need to evaluate it. Additionally, I said it has to be for a permitted purpose. And permitted purposes are defined as new or improved performance, functionality, quality, or reliability. And what this is in place is to prevent items that are aesthetic in nature. We're not going to take a red ball and make it blue. We're trying to take a red bouncy ball and make it bounce higher. So as long as you have that functional aspect, that's what they're wanting to incentivize with the R&D credit. Next, at the outset of the project, there must be technical uncertainty in relation to one or more of 3 things: either capability, methodology, or appropriateness of final design. Essentially, did you know if you could do it, how you were going to do it, or what the end result was going to be. That last one is a big catch-all because a lot of times when you're developing a new product, you don't know what the final design of that product is going to be until you go through the iterative development process to reach it. When you're developing a manufacturing process, you don't know the final result until you develop a process, test it with the first article run, and measure that part to make sure that everything's coming out right, and then making modifications until you get a part that is according to spec. Next, there must be a process of experimentation used to overcome those technical uncertainties. And the process of experimentation is a systematic trial and error. It's formulating hypotheses and alternatives to test those hypotheses. It is not random trial and error. It is not just seeing what sticks on the wall. Please note that it is okay to have a systematic trial and error process put in place and get it right on the first try, as long as you were prepared to go to the next iteration if that first trial was not correct. Finally, the project needs to be intended to discover information that is technological in nature. And what this means is that process of experimentation needs to be based on hard sciences such as engineering, computer science, physics, chemistry, biology, not soft sciences like marketing, accounting, or psychology or anything like that. If you meet this 4-part test, you then have a qualified project. Now, like all good areas of the Internal Revenue Code, there are exceptions and exclusions to this. We're not going to go into them today. That's getting into too much minutia. But be aware that there are items that you have to be aware of before you finish the qualification for the project. Now, once we have the project qualified, we can then capture up to 3 expense categories towards that project: wages, supplies, and 65% of contract research. I'll let you know from experience that wages are typically the driving force of the R&D credit. When you are dealing with startup taxpayers, the payroll tax that we've been discussing, supplies and contract research can make a significant portion of it, but generally speaking, wages are the driving force. Please note the 65% of contract research is a statutory reduction. That's just how they wrote the code. Wages are generally determined by the W-2 Box 1 wages. However, we can also look at certain earnings that are subject to self-employment tax, and when you have bonuses paid to employees, those go into the W-2 Box 1 wages, so we can include that as well. The types of compensation that are excluded include 401k benefits and fringe benefits, essentially pre-tax items. So that's where you get your wages, is looking at those forms there. Now, for supplies, in order to qualify them, the supplies need to be intended for use in the R&D process. So it is an intent test. If you're intending it for production, we can't capture it. Additionally, we can't capture land, improvements to land, or property subject to depreciation. And property subject to depreciation means something that has a useful life of more than 1 year. That being said, any tangible property that's intended for the R&D process, we can absolutely capture. And this includes lab animals, reagents, drugs, supply costs for prototypes for testing purposes, things like that. Now, when you have contract research expenses, this is anybody that you're hiring on a 1099 basis or through a formal contract, and includes outside consultants, engineers, software developers, and even contract research organizations. Now, the first step you look at is if they were an employee, would they be qualified, meaning they're doing qualified research. If no, then it doesn't qualify. If yes, then you have to proceed to what's called a funded research analysis. And what this says is that the person claiming the credit has to bear the economic risk and retain substantial rights. Now, every taxpayer I talk to says, yes, we bear the economic risk. Unfortunately, that is not how you do the analysis. The analysis is done on a legal basis on the agreement and or invoices between the two parties to make a determination of legally who's entitled or who bears the economic risk. And only one party or the other will bear this. This is set up so that the government does not pay a credit to two parties for the same work. Retaining substantial rights was kind of gutted by one of the court cases, and essentially if you retain any rights in the research, then you have substantial rights. Okay, I mentioned earlier that there were two calculation methods. There's the regular credit method and there's the alternative simplified credit method. With the regular credit method on a payroll tax calculation, you're going to save approximately 10% of your qualified research expenses in the form of a credit. With the alternative simplified credit, it actually ranges, it depends upon how the math works out, but typically we're seeing 8 to 12% of your qualified research as a credit. So this is not a huge amount at first sight, but when you get into the nitty-gritty and you start adding up all these QREs and then taking a percentage of them, it can add up to significant tax savings. Okay, your regular R&D tax credit, the one that's used against income tax, can be carried forward up to 20 years. Your net operating losses can also be carried forward up to 20 years. So a lot of startups don't see the value of using the R&D credit except as possibly a deferred tax asset if you're a C Corp. With the payroll tax credit, you get to use a certain portion of it against each quarter's payroll taxes until you use up the credit. There is no sunset provision on it. So this is an advantage. So as long as you're having payroll, you can continue using the R&D credit. Okay, so now let's go over some examples for life science companies where we're going to look at whether the company was qualified or not for the payroll credit. We'll then look at what the potential QREs were and the approximate value of the credit. So our first example is Preclinical Stage, all R&D all the time. This company was founded in 2013. Payroll and supplies came out to about $250,000, and the company has no gross receipts. If we're looking at this from a 2017 tax year point of view, we are absolutely qualified here because the company did not have more than $5 million in receipts in the current year, 2017, and did not have gross receipts prior to 2013. Now, on this, the CEO is leading the R&D experiments, and the laboratory technicians assist with those experiments, and the supplies were all consumables that were intended for R&D purposes. Consequently, we can capture all $250,000 here. Your FICA taxes, assuming the $242,000 in payroll, would come out to about $15,000, and we're getting an R&D credit estimate using that 10% figure of about $25,000. So this is offsetting not quite 2 years' worth of FICA taxes. So this is absolutely fantastic for a taxpayer to use. All right, example 2. Digital Health, it's R&D but faster moving. Founded in 2014, payroll of $1 million, had gross receipts in 2015 of $500,000, $5.5 million in 2016, and $4.2 million in 2017. This company is also qualified because during the grace period of that 5-year grace period I mentioned, we don't care what the gross receipts are. We just care whether the gross receipts in the current year, i.e. 2017, are more than $5 million. And we care if there were gross receipts prior to 2013, in which case there weren't here. Now, in this instance, only 75% of the payroll was qualified because most of the programmers were working on R&D, but the CEO had time fundraising and marketing, which is not considered R&D time. Additionally, there was an administrative assistant that also was working and was not directly assisting on the R&D. Your FICA taxes here come out to about $62,000. Your R&D credit estimate is about $75,000. So again, offsetting over a year's worth of FICA taxes here. Okay, example 3, clinical clients, R&D and approaching commercialization. This company was founded in 2009. Payroll is $1 million. They have outsourced contractor costs of about $500,000 and no gross receipts yet. This company is qualified because it meets those gross receipts tests of less than $5 million in 2017 and none before 2013. Only 70% of the payroll was qualified because they were doing R&D for the first and second pipeline drugs, but the sales and business development that's going on trying to get this up to full commercialization and selling does not qualify. Now, when looking at the contractor costs, it was determined that only half of it qualified, and then you take 65% of that qualified amount, which comes out to $162.5. And we were able to capture it here because they were an hourly contractor performing R&D. We're able to capture that because we bear the economic risk, and the contract was silent on substantial rights. Please note, lawyer and consultant costs for IP and regulatory issues generally do not qualify. If the attorney is actually working on the design of the product or process and providing input on how to change it and improve it, then we could possibly look at it. Again, your FICA taxes here coming out to $62,000. Your R&D credit estimate using that 10% method is coming out to about $86,000, about $70,000 from the payroll and about $16.25 from the contractor costs. So again, we're offsetting over a year's worth of FICA taxes here. All right, example 3B. Same thing, except the company did a one-off project in 2010 to get a little bit of revenue, $150,000 in gross receipts, and has not had gross receipts since then. This company is not qualified because they had gross receipts prior to 2013. We're not able to touch it. The only option they have is to look at the regular tax credit to offset taxable income. All right, example 4, an SBIR heavy client where some payroll is federally funded, founded in 2015 with $500,000 in payroll. When you have federal funding, you have to be careful about that because projects funded by grants are generally not allowed for the R&D credit. In this instance, the 100% of the company's payroll was committed to R&D, but 40% of it was funded by an SBIR and is considered not qualified. However, the company also does its own internal R&D, and we can absolutely look at that. So this is an instance where the company is taking advantage of an SBIR grant and taking advantage of the R&D credit. This is how you're supposed to be able to do this to go ahead and maximize your non-dilutive funding. FICA taxes, $31,000. R&D credit estimate, about $30,000. Okay. Just a brief overview of HIREtech. We work from the beginning of the hiring of the employee of the company, doing hiring tax incentives, going through the onboarding process. We look at technical tax incentives while the employees are at the company, and then if you have unemployment claims management going on, we're able to help out with that. Grants goes along this whole entire timeline. The technical tax incentives deal with the employees while they're at the company. We are experts in these technical areas. We don't specialize in a lot of areas of the tax code. Basically, your CPA has to know a little about a lot of topics. We're the neurosurgeon of the field. We have to know a lot about a little topic. And so this allows us to have the expertise to maximize these credits while ensuring sustainability. One of the ways that we do this is we have a series of attorneys and R&D engineers and PhD scientists such as Dr. Sederbo here and audit experts working on these R&D tax credits. An overview of the process for an R&D study is you do a preliminary analysis to make sure that the study appears viable. You do a project identification wherein you determine which projects are qualified, at least from a preliminary point of view. You then gather some financials and information on the projects and activities and do a series of interviews to determine that final qualified projects list, as well as determine the employee time spent on the projects and the supplies and contractors. We then do a credit calculation and issue a final report that includes the forms and schedules for your CPA to include in the tax return. With that in mind, we are going to open this up to questions. And if you have any questions, we'll be happy to answer. Our contact information is listed here. In case you don't want to ask today, you can follow up with an email or a phone call to us.
Thank you both. We do have a couple of questions. First, could you clarify, please, with the federal grant exclusion, if a company's only funding is 2 SBIR grants, are they excluded from this credit until they get other funding?
That depends on if those grants are paying for the payroll of the company. If the grants are paying for the wages of all the employees, then generally we won't be able to take a look at the R&D credit for them. However, it would be dependent upon how the grant was set up. A lot of companies have partial funded research wherein they pay for a portion of the employee's salary, and there's also internal R&D going on. So this is a situation where we would love to talk with you on a one-on-one basis to determine the exact fact pattern and whether or not you'd be able to take the R&D credit as well.
Okay. The next question is, what if I only pay people via 1099s as contractors? Can they still benefit from the R&D tax credit?
In that instance, you can calculate an R&D tax credit. However, you're not going to have any FICA taxes being paid because you're not paying employees. Consequently, there's no payroll tax to offset. So the R&D credit, if you're in a net operating loss scenario, might not be beneficial. As soon as you start paying the employees on a W-2 basis as opposed to 1099, then we can absolutely look at it.
And to clarify too, I mean, if you have complete contractor costs and you're making a profit and paying taxes, then sure, you can take the regular credit and use it to offset taxes in that case.
Okay, and we have just one last question. Can I take the credit if I'm fully funded by grants?
Did you say, can you take the credit?
Yes.
Generally not. A lot of times the government's already given you money through the form of the grant. They don't want to give you an incentive on top of that because you didn't have any risk on the employees in the first place. However, it's dependent upon the grant form. There are instances where you can still take the credit, but they're few and far between.
Okay.
Any other questions?
I think that is it for the questions that we have right now. Thank you both. I know your presentation will be really valuable to our audience.
No, thank you very much. We appreciate you having us today.
This concludes today's webinar.